in general, one would form the argument that developed markets are certainly less risky from a policy perspective, from a political perspective, from a corporate governance perspective. That is all true through the fullness of time. But everything at a price. If the prices of equities, for example, in developed markets get very stretched and the prices in emerging markets are much cheaper, which is kind of what happened last year. Emerging markets got beaten up badly and developed markets, particularly the US, continued up in a straight line right till the end of the year. Then the risk-reward ratio changes somewhat. And why I say everything at a price, because the best determinant for prospective years, for prospective returns 10 years out, is the price you pay for an asset today. So today emerging markets actually look much cheaper than developed markets in general, but the whole market has repriced to the downside somewhat.
Particularly in emerging markets, there's been a larger disconnect between the economic growth in certain countries and the performance of financial assets, particularly equities. So, for example, you've got over a quarter of the developed market indices are in technology, whereas in emerging markets it's about 16%. Financials are only 16% of the world indices, but they're again over a quarter of the emerging market indices. And then another big one is healthcare, generally seen as a very steady long-term growth industry, tends to have quite high returns on capital, decent margins. Again, it's about 14% of the global indices, it's about 3% of emerging markets. And yet, there lies the opportunity, because as emerging market populations have more access to healthcare because they can afford it or because their governments start to provide it as part of social packages, the potential for growth in those industries and emerging markets is enormous. So, you know, we're looking at, there are differences which can currently make a difference in the way that these are viewed and how they're valued, but which offer opportunities for the long term as well.
Emerging markets may be more risky because there's certainty about the future, but the compensation is they're starting off a lower base and the potential growth is much faster. Learning from the developed world, applying the technologies and the lessons of growth. So for 10 years now, with the exception perhaps of last year, emerging markets lagging behind developed markets in terms of returns to shareholders. So maybe there's a comeback there. There should be a comeback, I would say. And I think if you were looking for value in the world of investing, I think emerging markets at the moment, that's an opinion, seem to offer unusual value by comparison with the developed markets.
Even within the emerging markets, there are huge differences between them, either in terms of demographic growth. So China, for example, which is seen by many as the key emerging market, and in many ways it is, has a demographic problem not dissimilar to the developed markets. A lot of it to do with the one-child growth policy, obviously, from 30, 40 years ago. But its population is flattening out, and it has an aging population. You've got more growth in India in terms of population. You've certainly got more growth in Latin America in terms of population. So the dynamics of those economies are likely to be quite different from that perspective as well. Then you've got emerging market economies who are built on exporting goods, particularly resources, to the rest of the world. South Africa is a case in point. Brazil would be another one, huge iron ore and oil exports, for example. China is more of an importer. India is certainly a big importer. So, for example, when the oil price goes up, that's not great news for India. But when it goes down, it plays quite nicely into their hands, for example. So I think to put a blanket umbrella over all emerging markets, again, misses the nuances here. And the political cycles, which we've referred to, are quite different in a lot of these countries as well.
Look at the demographics of Africa, they're very promising. So its population's growing, it's a young population, it's a potential resource in terms of people as a source of growth, output. But of course it means you've got to adopt the right policy so that people, young people, introduced into the workforce become a strength rather than a weakness. Unemployed, as is the case in South Africa.
I think we've already seen what the risks of this happening. If you have a growing young population that feels that it has no opportunities and has no employment, I think the Arab Spring movement that we saw 5 years ago now was very much driven by that. Whether the same thing will happen in China remains to be seen. We think that there's an unwritten pact between the Chinese government and the people of China, which basically says, we'll leave you in charge as long as we keep getting richer. And the Chinese government is able to deliver that at the moment. Now, when they are no longer able to deliver that, that's when the interesting times start, and quite how the revolution, if you want to call it that, expresses itself remains to be seen. But social unrest to some degree, as indeed there already is quite a lot of, particularly in northern China, and a lot of religious-based unrest up there, which we tend not to hear very much about. So it's not all roses in China by any stretch of the imagination.
China needs to maintain its rate of growth to keep control, to satisfy expectations, and that leads them to hopefully appropriate behaviour. So the spat between Trump and China has every interest in keeping its growth going, and that may well mean access to the US market, which is an important source of demand. South Africa, commodity producers, we need China. China's demand is hugely important for metal prices, iron ore, coal, oil, whatever you produce. China has now the second largest economy in the world, half the size of the US, but maybe in 20, 30 years' time, bigger than the US. In fact, the retail market in China, market for retail goods and services, is now about the same size as the US. It's a massive market. And US companies want to get into that market. And they want to get into it in the way that Chinese companies can get into America. So they don't want the kind of close controls that China imposes upon them, and that's part of the argument.